Silver just hit $80 per ounce. We've seen silver climb from $29 in January to where we are today. And if you've been paying attention to what I've been telling you, this shouldn't come as a surprise. But here's the thing, it's not just silver. Gold is pushing all-time highs. Copper has surged, oil is climbing. Food prices are up. Real estate in certain markets is still inflating despite higher interest rates. Everything, and I mean everything, is getting more expensive. This isn't a coincidence, and it isn't just about one metal or one commodity. What we're witnessing is a complete repricing of real assets against paper currencies. And I need to walk you through exactly what's happening and why this is far from over. Let me start with silver, because that's where the most dramatic move has occurred. Silver has nearly tripled from its January lows. That kind of move doesn't happen in a vacuum. It happens when structural forces align in a way that overwhelms normal market dynamics. We've talked before about the supply deficit. Silver has been in deficit for 6 consecutive years. More silver consumed than mined every single year since 2019. In 2025 alone, the projected deficit is 117.6 million ounces. That's nearly 15% of total annual mine production that simply doesn't exist. Year after year, we've been drawing down inventories, drawing down stockpiles, and the market is finally recognizing that this cannot continue indefinitely. But here's what's different now. The deficit isn't just continuing, it's accelerating. Industrial demand has exploded beyond even the most optimistic projections. Solar panel installations are running ahead of schedule globally. Electric vehicle production is ramping faster than anticipated. Every 5G tower, every new data center, every medical device requires silver, and there's no substitute at scale. At $80, you might think the price has finally caught up to reality. But I would argue we're just now entering the phase where price begins to reflect true scarcity. Shanghai warehouses are reporting the lowest silver inventories in over a decade. London vaults saw record transfers last month as physical buyers scrambled to secure metal. Silver ETFs are seeing sustained inflows that dwarf anything we witnessed in 2020 or 2021. This is what happens when paper markets can no longer suppress physical reality. The disconnect between paper silver and physical silver has finally broken. And once that break happens, prices don't just adjust, they overshoot. Now let me zoom out, because silver isn't moving in isolation. Gold is trading near $4,300 per ounce. That's up substantially from where it started the year. Central banks are buying at a pace we haven't seen in decades. China, Russia, India, Turkey, Poland, Hungary, and now a growing list of nations in the Middle East and Africa are accumulating gold as fast as they can acquire it. Why? Because they see what's coming. They see the debt levels in Western economies. They see the money printing that never stopped, it just got rebranded. They see the weaponization of the dollar through sanctions and asset freezes, and they're positioning accordingly. Gold at 4,300 tells you something important. It tells you that the largest, most sophisticated financial institutions in the world, institutions with teams of analysts and economists and strategists, are betting that hard assets will outperform paper assets. Central banks don't buy gold for short-term speculation. They buy gold because they're preparing for a different monetary environment. Copper has been surging as well. It broke through $5 per pound earlier this year and hasn't looked back. Copper is essential for electrification, for green energy infrastructure, for the entire energy transition that governments around the world have committed to. You cannot build wind turbines without copper. You cannot build EVs without copper. You cannot build the grid infrastructure to support a renewable energy without massive amounts of copper. And like silver, copper supply isn't keeping pace with demand. Mines are aging, ore grades are declining. New discoveries are rare, and when they happen, it takes a decade or more to bring them into production. The supply-demand imbalance in copper is structural and long-term. Oil has been climbing, despite all the talk about green energy and reduced fossil fuel dependence. The reality is that the world still runs on oil and will for decades to come. Underinvestment in new production over the past several years is now showing up in tighter supplies. OPEC nations are managing output carefully. And geopolitical tensions in the Middle East, in Eastern Europe, and increasingly in other regions add a risk premium that isn't going away. Food prices are up across the board. Wheat, corn, soybeans, coffee, cocoa. Some of this is weather-related. Some is due to supply chain disruptions that never fully healed after the pandemic. Some is due to rising input costs, because when energy gets more expensive, so does everything that requires energy to produce, which is essentially everything. Real estate, despite higher interest rates that should theoretically cool the market, remains elevated in many areas. Why? Because people are looking for hard assets. They're looking for things they can hold, things that can't be printed, things that maintain value when currencies don't. What ties all of this together? The answer is simple, and it's something I've been saying for a long time. We are experiencing a monetary event disguised as inflation. When you print trillions of dollars, those dollars have to go somewhere. For years, much of that money flowed into financial assets, stocks, bonds, crypto. It inflated asset prices, while consumer inflation remained relatively contained. But now that money is leaking into the real economy, it's showing up in commodity prices, in food prices, in everything you buy. The official inflation numbers, the CPI figures you see reported, they don't capture the full picture. Anyone who goes to a grocery store knows that prices are up far more than the government statistics suggest. Anyone who's tried to buy a car, rent an apartment, or pay for healthcare knows that the real cost of living has increased dramatically. This is what currency debasement looks like in practice. It's not hyperinflation in the dramatic wheelbarrow of cash sense. It's a steady, persistent erosion of purchasing power. Every year, your dollars buy a little less. Every year, you have to work a little harder just to maintain the same standard of living. And here's what makes this self-reinforcing. As people recognize what's happening, they accelerate their movement out of paper assets and into real assets. This increased demand pushes prices higher. Higher prices validate the concern, which drives more buying. The cycle feeds on itself. This is exactly what we're seeing now. Silver going from 29 to 80 isn't irrational exuberance. It's rational recognition of monetary reality. Gold at 4,300 isn't a bubble. It's a reflection of central bank behavior and sovereign-level concern about the future of fiat currencies. Let me talk about the gold to silver ratio because it's still telling us something important. With gold at 4,300 and silver at 80, the ratio sits at about 54 to 1. That's come down significantly from where it was when silver was in the 30s and 40s. The ratio was pushing 70 or higher at various points. Now it's compressing. But historically, during precious metals bull markets, the ratio doesn't just compress to average levels, it overshoots. In 2011, the ratio briefly hit 30 to 1. If we were to see 30 to 1 with gold at current levels, silver would be over $140 per ounce. I'm not saying that will happen tomorrow, but I am saying the ratio compression has room to continue. Silver outperforms gold in bull markets. It always has. It's more volatile, it's more accessible to retail investors, and it has industrial demand that gold doesn't have. All of those factors suggest silver still has significant upside from here, even at $80. Now let me address something I know some of you are thinking. Is it too late to buy? I originally said silver would hit $100 by the end of 2026. With silver already at 80, that target looks conservative. We could hit 100 much sooner, possibly in the first half of 2026, possibly even before year end if we get a true short squeeze or if institutional buying accelerates. Beyond 100, the targets become harder to predict because we're entering territory silver has never seen in nominal terms. The inflation-adjusted 1980 high would be somewhere between 150 and 200 in today's dollars. That's the next major reference point. Could we get there? In a full mania phase with retail FOMO, institutional buying, and a genuine currency crisis? Absolutely. These are the conditions that create parabolic moves, and all the ingredients are present. My plan is to hold my core position until at least 120 or 130. At that point, I'll consider taking some profits, maybe 20 or 30% of my position. But I'll maintain significant exposure because I believe the structural forces are multi-year, not multi-month. This bull market isn't going to end because silver gets expensive. It's going to end when the underlying conditions change, when deficits turn to surpluses, when industrial demand slows, when central banks stop buying, when governments restore fiscal discipline. When currency debasement ends, look around. Do you see any of that happening? Now let me talk about the broader asset allocation question because silver and gold aren't the only ways to protect yourself. Physical precious metals remain the core of my hard asset allocation. There's no counterparty risk. You hold it, you own it. In a true crisis, when banking systems are stressed and digital systems are vulnerable, physical metal provides security that paper assets cannot. But I also think about real assets more broadly. Productive land, especially agricultural land, has value regardless of what currencies do. Energy assets, whether oil and gas royalties or renewable energy infrastructure, will be essential regardless of monetary conditions. Certain types of real estate, particularly land and properties with productive potential, can serve as inflation hedges. The key is to think in terms of real versus nominal. What do you actually own? Not what is the dollar value on a statement, but what tangible, productive, or scarce asset underlies that claim. Dollars in a bank account are a claim on future purchasing power. That claim is being steadily eroded. Stocks are claims on corporate earnings, which can be real, but are subject to market volatility and systemic risk. Bonds are promises to repay in future dollars worth less than today's dollars. Real assets, things you can touch, things with inherent utility or scarcity, those are what preserve wealth through monetary transitions. I'm not saying sell everything and buy silver. That would be irresponsible. But I am saying that a meaningful allocation to hard assets, more than the 5% that traditional advisors suggest, makes sense in the current environment. For me, that number is closer to 20 or 25% of investable assets. Your situation may differ. Let me also touch on what I'm watching for signs that the trend might be exhausting itself. The first thing would be a reversal in central bank behavior. If central banks stopped buying gold, or even more dramatically, started selling, that would be a significant warning sign. So far, there's no indication of that. Buying continues at record pace. The second thing would be a resolution of the supply deficit in silver. If new mines came online faster than expected, if recycling rates increased dramatically, if industrial demand slowed, the fundamental case would weaken. None of those things are happening. The third thing would be a genuine shift toward fiscal discipline in major economies. If the United States, Europe, China, or other major economies demonstrated credible commitment to reducing debt and stopping money creation, confidence in currencies might be restored. I see no evidence of that. If anything, the trajectory is toward more spending, more debt, more monetary accommodation. The fourth thing would be a change in market psychology. Right now, every dip gets bought. Premiums on physical metal remain elevated. Dealers report strong and sustained demand. If that shifted, if selling pressure emerged, if premiums collapsed, that would suggest exhaustion. I'm not seeing it yet. Until I see meaningful changes in these indicators, my stance remains unchanged. We're in a bull market for hard assets. The bull market has years to run. And while prices have already moved significantly, the biggest moves may still be ahead. Let me address the comparison to previous manias, because I know some people are thinking about the 1980 spike or the 2011 high and wondering if we're in similar territory. In 1980, silver spiked to $50 in what was clearly a mania driven partly by the Hunt brothers attempting to corner the market. That spike was sharp, and the collapse was equally sharp. Adjusted for inflation, $50 in 1980 is somewhere around $180 to $200 in today's terms. In 2011, silver ran to about $49 in a more organic rally driven by post-financial crisis fear and dollar weakness. It then pulled back and spent years consolidating. The current move is different in important ways. The supply deficit is larger and more sustained than at any point in modern history. Industrial demand is growing faster due to solar and EVs. The monetary backdrop is more extreme, with far more debt and far more money creation than in either 1980 or 2011. This doesn't mean we won't see corrections. We will. It doesn't mean we can't have a blow-off top at some point. We probably will. But the fundamental case is stronger than in previous cycles, which suggests the ultimate highs could be higher and the trend could last longer. I want to close by talking about mindset, because navigating a bull market requires more than just being right about direction. You have to be able to withstand volatility. Silver can drop $10 in a day. It can drop $20 in a week. If you're over-leveraged, or if you can't stomach seeing red on your screen, you'll make emotional decisions that cost you money. You have to resist the urge to constantly check prices. The minute-to-minute movement doesn't matter if you're positioned for a multi-year trend. Check prices once a day or once a week. Make decisions based on fundamentals, not daily noise. You have to have a plan for taking profits. Decide now at what levels you'll sell portions of your position. Write it down. When the time comes, execute the plan. Don't let greed convince you to hold everything to some fantasy price that may or may not materialize. And you have to maintain perspective. This is about protecting and growing wealth over time. It's not about getting rich overnight. If silver doubles from here over the next 2 years, that's an extraordinary return. Don't let the expectation of a 10-bagger prevent you from being satisfied with a double or triple. Silver at $80 is a milestone. It's validation that the thesis has been correct. But it's also just a number on a longer journey. The forces driving this move are not short-term, they're structural. And structural moves take years to fully play out. If you've been following along and buying silver as I've suggested, you're sitting on significant gains. Congratulations. But don't let those gains make you complacent. Manage your position actively. Take some profits when targets are hit, rebalance as needed. If you haven't bought yet and you're wondering if it's too late, the answer is no, but you need to be strategic. Buy in increments. Focus on physical metal or PSLV for the core position. Add miners for leverage if you have the risk tolerance. Don't chase. Be patient. Dips will come. The bottom line is this. Silver at $80 is telling us something. Gold at $4,300 is telling us something. Copper, oil, food, all of it rising in unison is telling us something. The message is clear. Paper currencies are being debased. Hard assets are being repriced. The smart money recognized this years ago. The public is just starting to figure it out. You have a choice. You can sit in depreciating paper and hope the trend reverses, or you can position yourself in assets that have maintained value for thousands of years and are currently in the early stages of a major revaluation. I know what choice I've made. I'm holding my silver. I'm adding on dips. And I'm watching this bull market unfold with the understanding that we're still closer to the beginning than the end. Thank you for watching. Stay informed. Stay positioned. And remember that in times of monetary instability, those who understand what's happening and act accordingly are the ones who come out ahead.